Right now, the Strait of Hormuz is in the news, and if you trade anything, oil, stocks, crypto, forex, what happens there is already affecting your psychology whether you know it or not. Here is something most traders do not understand. Markets did not start moving because of what happened. They started moving because nobody knows what is going to happen next. And that word, nobody, is the most dangerous word in trading. Not crash, not recession, not war. Nobody knows. Because a crash can be priced, a recession can be modeled, a war has historical precedent that analysts can reference. But nobody knows has no price, no model, no precedent that applies cleanly to this specific moment. And when the market cannot price something, it does not stay still while it figures it out. It moves violently in both directions. One headline says the strait remains open. Oil drops. Risk assets recover. Traders reposition. 6 hours later, the headline reverses. The strait situation has escalated. Oil spikes. Everything sold off in the relief rally is now wrong, and every trader who repositioned on the first headline is now managing a position built on a narrative that no longer exists. This is not a market problem. This is a psychology problem. Because the market is just doing what markets do, pricing available information. The problem is that the available information keeps changing, and changing information does not just move prices, it dismantles the psychological infrastructure that every trading decision is built on. In this video, we are going to examine exactly what that dismantling looks like, what it does to your decision-making, what it does to your risk management, and what the clinical approach looks like for trading when the one thing every trader depends on, knowing what they know, has been taken away. Stay with me. This one is different. Part 1. Markets are psychological systems. Most people think markets are mathematical systems, prices determined by supply and demand, valuations calculated by earnings multiples, risk assessed by volatility models and probability distributions. But the mathematics is the surface. Beneath it, markets are emotional expectation systems. Prices do not move based on current conditions alone. They move based on what participants believe about future conditions. And beliefs about the future are not mathematical. They are psychological. They are shaped by information, by narrative, by confidence in the reliability of what is known, and by fear about the unknown. This psychological foundation of markets is always present, but it is most visible, most exposed during periods of genuine geopolitical uncertainty. Because geopolitical uncertainty does not just change what traders know, it changes their confidence in their ability to know anything. And confidence in the ability to know, the meta-level belief that the information environment is reliable enough to make decisions from, is the prerequisite for rational market behavior. Remove that confidence, and the mathematics of pricing becomes secondary to the psychology of survival. The Strait of Hormuz is a specific and powerful example of this mechanism, because the strait is not just a geographic feature, it's a psychological anchor, a symbol of the stability of global energy supply, of the predictability of oil prices, of the continuity of the economic assumptions that underlie every asset class in every market in the world. When that anchor is threatened, when the possibility of disruption becomes real rather than theoretical, the psychological effect ripples through every trading decision made anywhere on the planet. Not because oil is the only asset affected, because oil is the input cost for everything, and the uncertainty around the input cost for everything destabilizes the expected value of everything.
Part 2. Why the strait matters psychologically. Approximately 20% of the world's oil supply transits the Strait of Hormuz daily. That statistic is known. It has been known for decades. But statistics are not what drives psychological responses. Threat salience is. For most of the time that statistic has been known, the strait has operated without significant disruption. The risk has been theoretical, acknowledged but not experienced. And theoretical risks are psychologically manageable. They exist in the background of decision-making, factored in at the margins, priced as small risk premiums. But when a theoretical risk becomes an active situation, when the possibility of disruption moves from background assumption to front-page headline, the psychological processing of that risk changes entirely. The threat becomes salient, immediate, personal. And salient threats do not stay in the background of decision-making. They move to the front, dominating attention, narrowing perception, shortening time horizons, increasing risk aversion, and driving the kind of behavioral changes that produce the volatile, irrational-looking price action that markets exhibit during genuine geopolitical stress. The Strait of Hormuz matters psychologically, not because most traders trade oil directly, but because disruption there represents something fundamental: the fragility of the assumptions that all economic forecasts are built on. The possibility that the supply chains, the price models, the earnings projections, the central bank policies, all of it, are built on a foundation that can be disrupted by a single geographic choke point. And that realization that the foundation is more fragile than the models assumed produces a specific and powerful psychological response: repricing of uncertainty itself. Not just the price of oil, the price of not knowing. Part 3. The shock of narrative reversal. Of all the psychological mechanisms that geopolitical instability activates, narrative reversal is the most destabilizing. Here is why. When a trader enters a position, they are expressing a belief about the future. Specifically, a belief that is grounded in a particular reading of current information. The position is the behavioral expression of a narrative, and the position's management, the holding, the adding, the trimming, is continuously calibrated against that narrative. As long as the narrative remains coherent, even if it is a negative narrative, even if the information is bad, the position can be managed rationally, because the trader knows what they are positioned for. But when the narrative reverses, when the information that supported the position is contradicted by new information, the foundation of the position collapses. The trader is no longer positioned for a coherent future. They are positioned for a future that no longer exists. And the decision of what to do, hold, cut, reverse, must be made from a state of genuine uncertainty about what the new narrative actually is. In the context of the Strait of Hormuz, this looks like this. Tuesday evening, diplomacy appears to be progressing. Analysts suggest a resolution is possible. Oil prices stabilize. Risk assets recover. Traders who were short energy cover their positions. Traders who were long risk assets add exposure. The positioning reflects the narrative. Things are getting better. Wednesday morning, new intelligence contradicts Tuesday's diplomatic signals. The situation is more unstable than previously understood. Oil spikes. Risk assets sell off sharply. Every position taken in response to Tuesday's narrative is now wrong. The traders who repositioned on Tuesday did not make an irrational decision. They made a rational decision based on available information. But the information was unstable. And unstable information produces positions that are correct one moment and wrong the next. Not because the traders lack skill, because the information environment itself is unreliable. And trading in an unreliable information environment requires a completely different psychological framework than trading in a stable one.
Part 4. Uncertainty is more dangerous than bad news. This is a principle that experienced market participants understand, but that newer traders find counterintuitive. Bad news is manageable. Uncertainty is destabilizing. When bad news arrives, when the event is definitive, the magnitude is known, the implications are accessible, markets can price it. The pricing process is not comfortable. It involves sharp moves, significant volatility, forced liquidations. But it has direction. It has a process. And once the bad news is priced, a new equilibrium is established. Markets can function from that equilibrium, even if it is a lower one. But when genuine uncertainty arrives, when the outcome is not just unknown, but fundamentally unknowable, there is no equilibrium to establish, because the range of possible outcomes is too wide, and the probabilities assigned to each outcome keep changing as the information environment shifts. This is why financial crises, geopolitical conflicts, and pandemic events produce such extreme and prolonged market dysfunction. Not because the bad outcomes are necessarily worse than the market feared, but because the uncertainty about which outcome will occur persists far longer than markets can function efficiently under. In the context of the Strait of Hormuz, this translates into a specific market dynamic. Oil at a stable price, even a high price, allows economic planning. Airlines can hedge. Manufacturers can budget. Central banks can model. But oil at an uncertain price, where the range of possible outcomes spans from stable to severely disrupted, supply makes planning almost impossible. Because every economic projection depends on an energy cost assumption. And when that assumption cannot be reliably made, the confidence in every downstream projection collapses. And collapsing confidence in projections produces collapsing confidence in the prices derived from those projections, which produces the volatility that geopolitical uncertainty is known for. Part 5. What this does to the individual trader. Let's bring this from the macro level to the individual level, because the psychological mechanisms that affect markets in aggregate are the same mechanisms operating in every individual trader processing the same uncertainty. The first effect is decision paralysis. When the information environment is genuinely unstable, when a new headline can reverse everything within hours, the rational response is to reduce exposure, to become smaller, to wait for clarity. But clarity in a genuine geopolitical crisis often does not arrive on a trading-friendly timeline, which means waiting for clarity means not trading, and not trading means not generating returns. And the pressure to generate returns, from personal financial goals, from performance expectations, from the psychological discomfort of inactivity, pushes traders back into the market before clarity exists, into positions taken not from conviction, from the inability to tolerate inactivity under pressure. The second effect is whipsaw damage. The trader who is nimble enough to reposition quickly in response to narrative shifts finds himself caught by rapid reversals. They cover shorts when the diplomatic signal appears positive. Then the signal reverses and they are short squeezed out of a potentially profitable position. They buy the dip on Wednesday morning, then further deterioration hits and the dip becomes a cliff. Each individual decision was rational given the information available at the time. The sequence of decisions produces damage, because the information environment is moving faster than position management can adapt. The third effect is amplified emotional responses. Under normal market conditions, adverse price movement produces a calibrated stress response, manageable, proportionate. Under geopolitical uncertainty, adverse price movement is processed differently,
because the trader does not know whether the adverse movement represents a short-term fluctuation or the beginning of a much larger move. The tail risks are visible. Oil at $150. Oil at $200. Supply disruption, recession, and visible tail risks amplify the stress response disproportionately, producing the overreaction, the panic selling, the abandonment of risk management that characterizes market behavior during genuine crises.
Part 6. The clinical approach to trading under genuine uncertainty. Let's be direct about what trading under genuine geopolitical uncertainty requires. It requires a completely different operational framework than trading under normal conditions. Not a modification of the existing framework, a separate one, designed specifically for environments where the information foundation is unreliable. The first principle of that framework is explicit information uncertainty acknowledgement. Before every trade taken during a period of active geopolitical instability, the trader must explicitly acknowledge the information environment. Not assume it is normal. Acknowledge that the narrative may reverse, that the position may be wrong not because the analysis was poor, but because the situation itself is genuinely unknowable. This acknowledgement changes risk parameters. It changes position sizing. It changes the tolerance for adverse movement. Because a position taken in a stable information environment can be sized for the expected volatility of that environment. A position taken in an unstable information environment must be sized for a wider range of outcomes. Smaller. Always smaller. The second principle is narrative-independent stop placement. In a normal market, stops are placed at structural invalidation points. In a geopolitically unstable market, structural invalidation points become unreliable, because the structure being invalidated may not be the trading structure. It may be the geopolitical narrative, which means stops must be placed not just at technical levels, but at the levels where the financial damage becomes unacceptable regardless of the narrative. Dollar-based stops, account-based stops, stops that define the maximum acceptable loss from this specific uncertainty exposure before the exposure is taken. The third principle is reduced frequency. During periods of genuine geopolitical uncertainty, the expected value of most trades decreases because the variance increases, and increased variance reduces the edge of any setup, because the market is responding to information that has nothing to do with the technical setup. The solution is not to find better setups. It is to trade less, to wait for moments of relative clarity, to accept that some market environments are not designed for active participation, and to protect capital from the noise of a market that is processing unknowable information, until the information environment stabilizes and the foundation for conviction-based trading returns. Part 7. Lessons from professionals in uncertain environments. One principle consistently observed among experienced traders who have navigated multiple geopolitical crises is this: when nobody knows, the correct position size is smaller than you think. Not small, smaller than small. Because in a genuine uncertainty environment, the tail risks are real, and tail risks require capital that can absorb them. Capital that has been preserved by the decision to trade smaller before the tail risk materialized. Another principle observed among risk managers who have managed institutional exposure through geopolitical crises is this: the goal during genuine uncertainty is not to profit, it is to survive. Survival in this context means capital preservation, maintaining the financial and psychological resources to participate in the market when conditions normalize. Because every crisis ends, Every geopolitical uncertainty eventually resolves into a new equilibrium. And the traders who are positioned to participate in that normalization, who have capital, clarity, and psychological stability intact, are the ones who profit from the resolution. The traders who were aggressive during the uncertainty have often depleted all three. Protecting capital during the crisis is the trade, not the trade during the crisis.
Part 8. Practical Tools for Trading During Geopolitical Instability. Let's get concrete. The first tool is the Uncertainty Classification System. Before each trading session during a period of geopolitical instability, classify the current information environment. Stable. The situation is known. The narrative is coherent. Normal trading parameters apply. Unstable. The situation is changing. The narrative is contradictory. Reduced parameters apply. Unknown. The situation is genuinely unknowable. Minimum exposure applies. This classification, made explicitly before the session begins, prevents the default assumption that today's environment is the same as yesterday's. It forces the trader to assess the information foundation before deploying capital into it. The second tool is the geopolitical position sizing rule. During any period classified as unstable or unknown, position sizes are reduced to a defined fraction of normal, 50%, 25%, whatever fraction was predefined during a calm state as appropriate for uncertain environments. This rule is applied before positions are taken, not after adverse movement occurs. Because adverse movement in geopolitical volatility is often swift enough that the decision to reduce size after entry is too late. The third tool is the Narrative Monitoring Protocol. During active geopolitical uncertainty, a defined process for monitoring narrative shifts, specific sources, specific update intervals, specific triggers that prompt position reassessment. This protocol creates a structured approach to information consumption during a period when information quality and stability are both compromised. The fourth tool is the Crisis Journal, a specific record of trading decisions made during periods of geopolitical uncertainty. The information environment at the time of each decision, the narrative that informed the decision, the outcome, and the assessment of whether the decision was appropriate given the information available. This journal builds institutional knowledge about how you personally respond to geopolitical uncertainty, your specific vulnerabilities, your specific decision patterns under this type of stress, and the specific adjustments that produced better outcomes versus worse ones. That personal data is irreplaceable, because geopolitical crises recur, and the trader who has documented their response to previous ones enters the next one better prepared, not immune to the psychological effects, better equipped to manage them. Closing. The Strait of Hormuz is a shipping lane, but in the context of global markets, it is a psychological amplifier. When it is stable, the market can function normally. When it is uncertain, the market cannot. Not because the mathematics change, because the psychological foundation that the mathematics sit on, the confidence in the reliability of expectations, is disrupted. And disrupted confidence produces disrupted behavior in markets, in institutional portfolios, and in the individual trader sitting at a screen trying to make rational decisions in an environment that has temporarily stopped being rational. The clinical response to that environment is not to pretend it is rational. It is to acknowledge the instability, to size appropriately, to reduce frequency, to protect capital, and to wait, with patience, without urgency, without the pressure to perform in conditions that do not support performance. because the environment will normalize. It always does. And when it does, the trader who preserved capital and clarity through the uncertainty will be positioned to participate in the normalization. The trader who was aggressive during the crisis will be recovering from it. Choose the first, every time. Your growth as a trader begins with self-awareness. The rest follows. I'll see you in the next video.